Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Monday, August 5th, 2024. When I woke up this morning, I swear I thought it might be a Black Monday, and it certainly was in Japan, but not so much in the US. It felt that way, but we didn't get like a 25% drop in one day or anything like that. Could that be coming? I think it could be. I don't see what's stopping this bear train to just lay it all out there, but let's go through the points. I just want to start by repeating that the SOM rule has been triggered, and this normally indicates that the recession has basically officially started. So unemployment rate is now it triggered and is going this way, and so when that happens, it tends to collapse on itself. People can't get as much work, they can't spend as much money, companies therefore can't make as much money, therefore they have to not hire as many people, and it cycles on itself, and that's how recessions work. Companies go bankrupt. Companies that were surviving on money being too cheap can get wiped out. And not every business can survive or is supposed to survive. That's sort of how nature works. However gruesome or whatever you want to see about it, genes and memes is what drives the world, and it's similar in business. And we're there. We're at the point where the tide's going out, and we see who's wearing clothes and who isn't, and we will be wiping out bad credit, at least the way that I look at it. Very notably, the Dow was down 2.6%, S&P 500 down 3% today. Again, this is after Friday's, I think, even larger decline. I think the Russell was down. It was down at least at one point on Friday at 4%. And again, right after that, the very next Monday, NASDAQ down 3.4%, Russell 2000 down 3.33%. I see other traders talking about buying the dip here and then getting out right away because nothing goes straight down, but it's going down straight so far. And to try to catch this and hope that there's a bounce and hope that there's enough people on your side, I mean, it just seems overly risky to me. My favorite risk reward right now, that my account personally is up another 1%. It was up over something between 2 and 3% on Friday, and was up another 1%. How did I do it? Treasury bonds with leverage. No matter the way I see it, no matter what, I win on the long bond treasury trade. If the economy falls apart, well, we all know what happens. They slam rates down to zero. People rush into safety, pushing rates lower. And what can even make that go even more into the bond holders' favor is QE. When the central bank says, okay, you know what, we need rates to stay even lower, so they start buying billions of dollars of treasury bonds like they did for COVID, like they did for the past QE cycles, and the price of bonds goes way up. And if you're holding those bonds, that's when you can sell them for undervalued, more something like a high yield corporate. It's how you do it. It's how you play the cycle. Graham even basically in a roundabout way would agree with this and say, yeah, that this seems like an obvious operation, at least from my perspective. Anyway, yeah, so a big part of this stock market collapse, if you're unaware, there's the Japanese central bank has, they're talking about, and they're planning to, or already have, I don't know which it is, they're raising their rates is the point. And for a very long time, people have been able to basically borrow Japanese yen for free, or even get paid when you have they've had negative rates, so you could actually borrow Japanese yen and they would pay you to own it. I know that sounds crazy, but It has happened in the past in Germany as well, and I believe it had been happening in Japan. And so when you have near zero rates or negative rates, that money can go into other assets that can increase in value or gain, more yield. And so when the way that unwinds is that when you're borrowing Japanese yen and all of a sudden you have to pay money on owing that, well, all of a sudden that, even if it's a small increase, or even if it's going from negative to zero, or negative to just above zero, suddenly you owe money on that money that you're borrowing. So you might have to deleverage yourself. You might have to take some higher risk assets off the table and sell them so that you can, not owe money on the Japanese yen, and then it makes the yen stronger. And so, yeah, people have been talking about how the yen has been collapsing and how terrible that is, and we're obviously going the other way now. And so, if you look at the Japanese stock market, it's called the Nikkei 225. It dropped. This is like a Great Depression number. The 1929 crash, I believe, they had 2 days in a row that was 25%. So not quite 25%, but 12% for an entire country's stock market index it's just epic. That's insane. This is a historic day. They might call it Black Monday in Japan. I don't know. Anyway, moving on through my points I wanted to bring up today. I mentioned on Friday how high risk assets hadn't really woken up to the reality of the bear market and what's going on. And the way I look at it, and I predicted people would see it over the weekend and digest it, and they'd start to figure it out today. And it's playing exactly the way that I had seen in my crystal ball. High risk assets did wake up to the bear market. You could see this in high yield corporate going down today. Bitcoin obviously went down something like 10%. Very big move, especially based on recent movement. I don't know where it's at right now, but it was down 12% at one point for the day. And just to finish going through my notes for the day, the way I look at it, there's no data this week, and so I don't see anything stopping this trend, and I don't know when it's going to end, but I don't see anything stopping this bear train, and I see it as a bear train again. And then daily reminder, 2-year 10-year yield is still inverted and past its second birthday. This is a very dependable indicator that predicts recessions, and for it to be inverted for 2 whole years is very serious. It's very, very, very serious. On to the charts. The Nikkei 225, as you can see, dropped over 12% today in one day, and I don't see what would stop this from continuing, but I don't know. I guess we'll see. SPX, this is the S&P 500 on a daily time frame, and as you can see, I had written this trend line, show it's the parallel of high to high, right? And then you just drag it to this low here. And so you had a major psychological level which held up the market on Friday, and we broke so hard through it today. To be honest, I said that, I expected this to continue being very bearish over the weekend. I didn't expect it to go this fast. I actually expected maybe a little bounce even for today, and then Tuesday a crash. But we are just, this is I mean, if you're trying to buy this, the way I look at it, it is like trying to catch a falling knife. And if you've ever tried to do that, you might know what happens. Anyway, I digress. This is very scary looking to me. On a weekly time frame, equally scary. The huge gap down. These are weekly candles, just jumping down from this week down to this the start of this week. I just wanted to give a visual of this to show just how extreme this move looks on the chart. I mentioned at the beginning of the video, high risk, dumb money, didn't really wake up to this. Well, so one of my favorite leading indicators as far as, what's the real dumb money doing? I look at cannabis ETFs, and this one collapsed. It says 8.2% today. So it woke up, right? Now the IWM is not, the Russell 2000 is not like dumb money. It's the dumber money, maybe you could argue, of the stock market. Not like the dumbest possible money, but is also down 3.2%. I had been wondering if we were going to hold up this trend line here, but we're just smashing right through it. I don't know if anybody's buying dips here. I don't know how they're doing it and how they're going to be successful at it, but good luck to anybody that wants to play that game. I wanted to bring up the VIX, the VIX. This is the best fear indicators. It involves the price of options contracts. When this thing spikes, it means that there is a lot of volatility in markets, and the expected movement, the options pricing goes way up further away from the current price, and that's how this sort of works. And so we had a historic spike today. We got up to 65 in the VIX. This is, I don't know if you can see it on your screen, the wick of this candle, though, goes all the way up to 65 intraday. Just to put that into perspective, this is actually a weekly chart. It was only today that we got up to that level. The last time that we got up to that level was March of 2020, and before that, we have not seen 65 since the Great Financial Crisis in 2008, which actually we eventually peaked at 89 in this metric. Now, I think it's possible for this to continue going higher. I'm not going to say that, it would actually be more normal for this to be it. That's the end of this part of the volatility, but I don't think it is. And I think I can say that because of how unbelievably overvalued so many stocks are, especially the mega caps, and how much capital destruction is possible on a simple perceived slowdown of earnings for these companies, which is what Graham in his books always talks about. The risk of having a lot of growth priced into securities is not that the earnings will go down, but that they'll just slow down, even just a little bit. That, you don't think the company can earn double the amount of money every year for the next 10 years. While it's currently priced that way, it's very problematic, especially for companies that have these gigantic market caps in the trillions of dollars, that the price just doesn't make any sense. We are in my opinion, a massive bubble, and not only in the mega caps, but in stocks in general. I don't think we've had a real cycle since before 2000 where valuations of stocks became normal. One way I would like to illustrate this is, if you own Apple stock, you have to realize, let me get the numbers up, that when you buy Apple stock, you're paying $210 for a share today, and it will pay you $1 a year. Now, I gotta ask you, would you give me, Robschild, $210 to promise to pay you $1 a year for every year for the rest of your life? Would you want to do that? Well, probably not. You'd probably want more money than that, and that's one of the problems I have with a lot of corporate America right now, is this whole money just going back into corporations, not even paying out. And at the end of the day, stockholders need to eventually realize what they're actually getting by owning these stocks. $1 a year to own Apple stock is insane to me. They might pay out $1.10 next year, and then $1.15 the next year. They might, and they might not. But to price all this in already, it's pure craziness. Anyway, I digress. Let's go back to the charts. I just want to point out that it is not impossible for the stock market to drop like by 90% in my estimation. People are saying 30%, 50%, 80%. I'm going to say 90 is possible. Also consider the money flows. The valuation of the S&P 500, Apple, so many of these mega caps, they are functioning like a Ponzi scheme. They are depending on other people to bid up the price in order for the price to continue being at that price or going higher, and it's all insane. Sorry, I'm getting a little emotional about this whole thing. It's just I don't know. Take a look at the PE ratios of the past 150 years. They sometimes go down to 7 on the S&P 500 on like all the common stocks that are owned or whatever. To stay above 20 or to get up to 30, it's the risk here. It's extremely dangerous. It's just extremely dangerous, and we're seeing that danger come out of the market a little bit today. Will it continue? I don't know. I think that it will. I think it would make sense if it did, but I don't have. Oh, I do have a crystal ball. Again, the VIX today, it's a historic day. We hit 65 on the VIX. The only other times we've done that in the past since 1990, this chart goes back to, is 2020 and in 2008, just to emphasize what's going on here. This isn't just some dip in the market. This is like all heck breaking loose. Again, can it reverse tomorrow? Yeah, it can. I mean, look, 2015, we had a big spike up to 53, reversed down. Nothing burger, nothing happened, right? Again in 2018. 1998, this big spike. You hear anything about that? No. So, can this be over? Maybe. Sorry I keep repeating these points. It's just, things got kind of crazy today, obviously. I mean, it was historic. So, if you're like me and you have leverage on long duration treasury bonds, you are pretty happy with yourself right now, as I am. And will this continue up? Well, I hope it does. I don't know if it will. I'm still holding it. I think it's, like I already talked about that earlier in the video, risk reward wise, it just makes the most sense to me right now for where we are with everything. Anyway, I've been talking about HYG. I have puts that are now in the money actually on this. This is high yield corporate. We opened at 76.65 and closed 77.22. My puts are for 77.50. I expect this to continue to go down. Just to also point out, credit spreads are now spreading. So when you have TLT going up at the same time as something like HYG, HYT dropping, that's like risk off. That we're in a risk off mode now, obviously. And fear and greed index, we are in extreme fear. Again, I don't expect this to stop, but it might. I don't know if it'll bounce. I don't actually expect it to bounce right now because of how crazily high stocks have gotten recently. But again, we'll see. Want to point out very notably the Fed funds futures. We now have, let's see here, 0% chance of no cut in the September meeting, and 86.5% chance of a double cut, 50 basis point cut in September, and then another 25 basis point or another 50 basis point cut in November, and then same thing for December. So looking out to December, we're expecting one, let's see here, how does this work? 1, 2, 3, hold on, because this counts as one cut. 1, 2, 3, 4, 5, 6, 5. No, 5. We're expecting 5 cuts now through the end of 2024. We might even get 6. That's very interesting. So not all markets went down today. Notably, one of my holdings, I have Chinese equities. They went up today in value. With all the fire and brimstone going on in markets, certain things are doing okay. Chinese equities actually got a bid today, believe it or not. Part of that is money running away from U.S. stocks and shifting, and money's got to go somewhere. So some of it found a place there. Most of it's going to cash in treasuries, in my estimation. Just wanted to bring up one other thing. Wood, one of my other favorite leading indicators involving the Global Timber Forestry ETF. It's WOOD is the name of the ETF. It dropped significantly today, 3%. Just absolutely gapping down here. So another leading indicator still showing a lot of weakness. Again, I don't see what's going to stop this unless the Fed literally comes out like tonight or tomorrow sometime and says, hey guys, don't worry, we're going to give you free infinite money again, which they can do, and they might do. I don't think they will. I think they're going to sit on their hands and let Bitcoin bleed out a little bit. I mean, come on, honestly, it would make sense for the Federal Reserve to, and the U.S. government to want that to happen. They don't want Bitcoin competing with the U.S. dollar. I think they're going to sit on their hands for a little bit here. But that's just me and my crystal ball. Emotional day, crazy day, rare day, historic day. That's all I have for today. Hope you enjoyed. Thanks for watching. Robschild.